Please welcome the panel on the future of asset management, moderated by CEO of the Milken Institute, Richard DeTizio.
Hey, good afternoon, everyone. Thank you for joining us. As I was thinking about putting this panel together compared to last year's asset management panel, I was thinking, God, if only something interesting had happened in financial markets in the last 12 months. So we hear a lot about this unprecedented uncertainty. I'm not sure how unprecedented it is, but we did see a contraction in U.S. economic activity reported last week, a potential marker for slower U.S. and global growth. And at least in the short term, as we await the full impact of tariffs on trade policy, potentially to trigger prices, forecasters, along with CEOs of many companies, have scrambled to adjust, often saying that there's too much uncertainty even to put a forecast together. And all of this reflected in the most recent Federal Reserve Beige Book report, where 9 of the 14 regions in the U.S. showed no growth or just modest decline in economic activity. We also saw a significant sell-off after Liberation Day. In 7 days, the S&P dropped 12%. A lot of coverage on that. It's also recovered it entirely. Not so much coverage on that, but all of those losses have actually been recouped. So what is an asset management company to do in the midst of all this? You've got shifting monetary policy, the integration of AI, geopolitical tensions, and at the same time, clients are increasingly wanting personalization of their portfolios and agility in their portfolio construction. So I'll start with the person who has come the furthest, Raf, joining us from Australia. I know that the Future Fund last year released a report on geopolitics, and the paper called for managing geopolitical risk proactively. But given that the very nature of geopolitics is rife with risk and uncertainty, how can investors think about quantifying that in some way to manage the risk?
Yeah, thanks, Richard. So it depends, of course, what sort of investor you are and how active you can be across your portfolio. All my colleagues here to my left are all active managers on behalf of third parties. We would think about it for ourselves. So the essence of the research that we did in the paper that we wrote was basically saying, unlike the last few decades where economic outcomes, macroeconomics was driving market behaviour and returns, we thought we were going to see a lifting in geopolitics as a driver for how markets operated, primarily because the world was becoming more multipolar, and countries would see their market policies and stimulus policies through the lens of national security and national champions, basically, the types of companies that work for them. So really the essence of what we were saying was, don't try to pick the event, you'll get it wrong, and even if you get the event right, as he said, the market will go down, the market will come up, maybe the event's not really that important, it's the trend that's important. And so what we're saying right now, and this changes through time, but we think this trend will be sustained, the world is fracturing. We've got the rise of a multipolar world with more localised, dominant economies or governments, both from a geostrategic, military projection point of view and from an economic and trading point of view. We're seeing that with the policies around tariffs, for example, which are designed to deglobalize trade across the world. And you can project that forward and understand that that will have certain types of impacts on both monetary and fiscal policies in different countries, on how they deal with their currency, whether they let it float freely or not, whether there are capital controls. And so on the one hand, we would say you want to be quite diversified in that type of world because it's very hard to pick winners, at least geographically. I think what we're seeing as a foreigner, sitting here today in the US, looking at the US administration's policies, which the Treasury Secretary spoke about this morning, they're openly saying they don't want the US dollar to be the world's reserve currency with all the costs that come with that for US society. Well, that's a pretty loud warning bell for a global investor who has a lot of exposure to the US and US dollars. So we think more diversification is better. But I think the real nub of it is things change really quickly in geopolitics. Individuals make decisions that can lead to wars or stop wars. changing trade routes, taxes, all sorts of things. So you have to stay liquid and you have to stay nimble, and that's something that we're taking into account as well.
Okay. So let's stay on that staying liquid for a moment and go to Gene. There still seems to be an awful lot of cash on the sidelines. At first, it seemed the market was too expensive to enter, people waiting for an entry point. Now people are afraid of the risk to enter. As Secretary Besant said this morning from the stage, this process is not going to be linear or pleasant. So how are you advising clients at Wellington? What guidance are you giving?
So I would say versus 22, where a lot of money came out of assets into money market funds, not even bond funds. I think we're seeing a little, I'm curious about what my peers here are seeing. We are definitely not seeing a significant outflow, and we're seeing more interest in active management, even in this volatile time. So maybe it goes to what Ralph was saying, that the indices the indices were so concentrated, so clients are looking for more diversification, and they seem to be looking for more diversification in plain old active equities for the first time in multiple years. So we're definitely seeing that trend, which so even in this kind of environment, all we can do as an active manager and a research-based firm is to make sure that we are doing what we do best, which is to research we research the vast majority of companies in the world, and we research as well as many private companies, and trying to connect the dots about what could happen, and we're doing a lot of scenario analysis about what could happen with the policy, whether it's tariffs or trade or deregulation, how Europe reacts, how Japan reacts, and just trying then to spend a lot of time then thinking about what portfolios look like. And I would say, I said this to someone today, I think there's not a fear. I think it's more, there's an energy. If you think about the last decade, we had one-way markets, macro-driven markets, and then the last couple of years we've had very highly concentrated markets. And so for us as an active manager, I think this period of a lot of volatility and a lot more dispersion has actually provided, and the ability to research and try to say what could happen, instead of fear, it's actually more of an opportunity that I think our investors are seeing.
Okay. So Mike, I want to go to you, and there's always this debate between active and passive management, which outperforms in what market conditions, et cetera. But you were just telling me you've seen an extraordinary inflow into active ETFs. Like, give us the sense of where you see the consumer mindset in between those two.
It's interesting. In active ETFs, and we were talking before we came up here, the statistics are pretty remarkable. There's $1 trillion now in active ETFs in the US. So what was 100-0 passive active is now 90-10. But the flows year to date are 40% into active ETFs. So that 90-10 will go 80-20, 70-30, 60-40 over the next 10, 20 years. And Gene was talking about it. You're seeing a broadening of the market. Last year, 7 stocks were accounted for 53% of the return of the S&P 500. That is not a great environment for active management. When you have a broadening of the market and people are able to look at companies and see growth in small caps and dividends and stocks outside the United States, and you're able to do real analysis and find companies that will look a lot better 5 or 10 years from now, it's a huge opportunity for active, which we're seeing in our numbers, and I'm sure others are as well. So you have sort of a perfect storm of the availability of the vehicle, which is more tax efficient, and the broadening of the market so you can outperform the benchmarks, and that's what you're seeing drive flows.
Okay. So Bill, let's go to you. So I know there's this move towards democratization of access towards alternatives, which is obviously a great opportunity to expand the net of who can invest there. But the illiquidity and complexity of those structures previously were guardrails, which kept certain investors away. How can investors understand all the risks and opportunity in the space, and how does Nuveen think about that?
Well, I mean, that's a great question. We were talking about that before we came out here. Obviously, ETFs, private markets, overlay of SMAs in the wealth market. All these things are changing the entire way I think wealth clients are looking at the market. And so when you think about bringing privates down to the wealth individual, it's a very difficult, not only are you training your own team to explain these things to an FA who's then talking to a client, it gets very tricky. And for companies like ours who have public to private assets, we're bringing 350 billion of private assets to our clients, and we're having success, but it's taken several years to educate clients and our own staff on how to sell those to the end client. And I think that is a real challenge for all of us as we can, over the next 2, 3, 4 years with clients, because they may not totally understand what they're actually buying.
Okay. So Matt, let's go to you at Global Infrastructure Partners. There's some current headwinds against ESG, not everywhere, but certainly here in the United States a bit. Has investing in the energy transition become harder or easier over the years? And is there enough deal flow to keep that trend going?
Well, I think if you look at the overall umbrella of infrastructure and what's driving sort of a golden age of opportunity, to me, the energy transition is the biggest opportunity over time. $100 trillion over the next 25 years. And why do I say that? We're all beneficiaries of this fossil fuel-based economy that is 200 years old. We're a bit energy blind, in my opinion, and that has a couple of components. First of all, I think most people fail to appreciate the density and the power and leverage in fossil fuels. So here's a very simple statistic to illustrate my point. 1 barrel of oil equals 4.5 years of a single human's labor. 1 barrel of oil takes a single human working a certain number of hours per week, 4.5 years to get the equivalent amount of productivity. Fossil fuels are also scalable, they're transportable, they're a lot more dense. You don't get the same trade-off, a barrel of oil to a megawatt of electricity. It's a very different relationship. And my point is the complexity associated with the energy transition, you're seeing it play out today. It's expensive, it's complicated. And so when you ask, is it harder or easier? I think from our perspective, because we've always thought it was going to be nonlinear, because you're balancing energy transition against energy security and energy affordability. And the deals will have to make sense on that basis. It's been slow. It will continue to increase. But my prediction is 10 years from now, energy transition will be its own asset class.
Okay. So, Gene, I want to go to you as you're a longtime healthcare and biotech analyst and investor. As the U.S. government recedes from funding medical research, does that create an opportunity for investors in any way?
So I think it's probably too early to say how they'll recede and how much they'll recede. But I think what is clear is that the biotech and pharmaceutical companies do not do basic research. That's just not what they do in their companies. They're not, I wouldn't call them the last mile, but they take over that basic research and then they focus on the preclinical development, the development, and bringing it to market. And that's where actually most of the costs are. But without the basic research, you wouldn't get some of the big breakthroughs we've seen over the last 30 years. So I think if the US government retreats, I think it will be an opportunity for other governments and other universities probably around the world to begin to contribute possibly more to basic research. You could see the private sector coming into basic research more. It's the key to everything. I guess I'm an optimist, and I would be surprised if the U.S. government, over the long term, seeds the innovation economy, the innovation research that drives our economy. It's not just biotech and pharmaceuticals; it's also the technology. But clearly, we're going to go through this disruption short term.
Okay. So Let's go to you, Raf, because as you mentioned, you are a non-U.S. investor looking at all of the dynamics unfolding in the U.S. When I visited you in Australia a couple of years ago, I was very taken with just how important diversity and inclusion was to your staff, and just you felt it palpably at the fund. What do you make of the pushback to DEI here in the United States, and how are you thinking of it for a future fund? Here, just anecdotally, even though there's a pushback from the policy perspective, recent shareholder meetings, 98% of Goldman Sachs shareholders, 99% of Levi Strauss shareholders, and 98% of Pfizer shareholders rejected anti-DEI proposals which were submitted. So give us the take from a non-US view.
Yeah, thanks, Rich. Just an easy question to answer. Look, I think all of us are in the business of making complex decisions with uncertainty and bad information. Like, that's what you do when you're an investor. Added to that, right now in the world, there's a lot of change, so the things that you thought you knew, you're probably going to get wrong. And so for us anyway, we sort of think, well, having the most diverse group of people around the table with different perspectives, different ages, different genders, different educations, everything, just gives you the best chance of understanding and predicting what might happen. But of course, that you need those people, but then you need to get them to feel comfortable to speak up, to challenge, to tell you what their view is. That's not a policy, right? That's just good business. And all of us, I'm sure, should be and are doing that in our own firms. Every company should be doing that. I think where the issue arises is that, of course, in the fractured politics that really the whole world is experiencing at the moment because of these changes that I talked about, it's most acute here in the US. I think Americans just like to get excited about policy debates and take sides and fight with each other. You know, we're taking something that's just common sense and a good business and turning it into a fight about you're right and I'm wrong, whichever side you're on. And I think everyone on both sides of that sometimes takes it too far. And I think everyone admits that, like when you find examples of, you know, frankly, discrimination on both sides, right? Mm-hmm. And if we're all just sensible and bring it back to common business, like common sense, not only should it be fun, that's why every sensible person supports it. I think where it's getting interesting for us, for a global investor coming into the US, like all of you, like most of our fund managers are based here or at least have significant operations here. And as the laws change here, it's becoming more and more difficult for them to answer pretty basic questions we have about how can we be confident that you're making good decisions.
Okay. So let me pivot to the notion of size. I'll go to you, Mike. I'll note that the aggregate AUM of all of you is roughly $6 trillion on the stage. Are the big firms getting too big? Tell me what the advantages of size are and what's the downsides of size.
Yeah, when you have, and we are just under $3 trillion of assets, size is a benefit and it also can be a challenge. And we think about that all the time. Part of our planning on our long-term strategic plan for 2031 was how do we do the same or better for our clients as we grow assets? Because we measure ourselves by outcomes, not AUM. So how do you make sure you have better outcomes? One of the things you do in investment management is you keep making yourself smaller. So you keep breaking into groups so those ideas don't just get lost in the system of noise. Capital Group did that long before I joined in a concept of disaggregation. So we have 5 investment units managing that $3 trillion pool of assets. And so that proliferation of investment units helps us stay small when our assets are big. The benefits are scale. And it's a scale business. The bigger getting bigger. It doesn't even matter what industry we're talking about, the bigger getting bigger. And when you have that kind of scale and you're a private entity, and Gene, I'm sure, has the same type of benefit, you're able to invest in your business when some others who might be public and don't have scale can't. You can deliver more to your clients. You can extend your advantage. So what I always say to our team is, if you're not taking advantage of one of your biggest advantage, it becomes a disadvantage. So we try to take advantage of that scale, add more resources to our clients. When our team says, but we're ranked #1 in thought leadership and #1 in practice management with financial advisors, my question is, how do you extend that advantage and help more people, not rest on your laurels? So trying to use those resources and scale to benefit clients is mission 1.
Okay. So let's talk about attracting and retaining talent. Bill, I want to go to you. In this very competitive environment where talent is moving from one firm to another, how are you thinking about not just AI, but other automation tools that are available to you and your staff? And I want to follow up on something Gene said, that over the last significant period of time, markets have generally moved in a unidirectional way. So younger people have not experienced the same kind of market cycles that older people have. Does technology step in and replace the wisdom that all of us older people have, having seen so many different markets? And how are you attracting the young people into the firm?
Yeah, so well, first, in all of our businesses, people are the key asset to what we do. And we have to deliver investments, we have to deliver performance, we have to deliver outcomes to those individuals. So retaining people come in a variety of ways. Obviously, you're paying them well, you have incentives, you have long-term incentives that keep them in place. You motivate them to want to be at your organization, and they'll stay. With technology, the way we're using technology today, and I'm sure everybody else, we're all testing technology and how to use AI. AI is not going to replace them. You still need them to be able to think, make the investments. It's going to make them more efficient. And in a scale game that Mike was just talking about, you have to get, fees are going to get compressed in our industry. That's why scale is important. You've got to make it more efficient, and you've got to deliver investment returns. So using AI, we use it today to help our research analysts. It goes through a lot of information down very quickly so that then the analysts can actually make better decisions, quicker decisions, investments can happen faster. It's actually making us better investors.
Can I just add there?
Sure,
I
please.
think it's upon us, all of us. Like, this is such a fantastic industry, and how do we make sure young people realize what a great industry it is? And we don't do a good enough job as CEOs in this industry to say the importance of the asset management industry to innovation around the world. And so when I try to motivate our young employees to say this is a great career versus other industries you could do, it's both. You are providing long-term retirement to people all over the world. That's number one. Or to countries or to individuals. Number two is we get to decide where capital is deployed. And back where what Matt said, the next how many years? Did you say 10 years?
4.5.
4.5 years, the amount of capital that will be deployed to do amazing things in the world. It's sort of the secondary benefit of this industry. I personally have been involved in helping to fund companies that treat a lot of yourself and your family, and that's like one of the things I'm most proud of in my career. And so we need to tell that story and tell it in a motivating way to keep to make the young people in this that are coming out of college or in their 20s to say, wow, well, this is a fantastic industry. You have people that will mentor you to teach you how to be an investor, and so that's one of the things we talk about a lot.
Yeah, one thing I would add is a lot of folks who are in more commoditized type functions, you have to spend a lot of time developing them into different roles. I was asked a question in one of our events we had internally, and someone said, can you tell me that AI is not going to take away my job? My answer was, absolutely not. I'm going to tell you that AI is going to change most jobs and create plenty of jobs, but you need to invest in your own career, and we need to invest in your career, because a lot of things will change in the next decade. Yeah. So you have to be a participant in that. You can't be a bystander in the change and development of people. It's a contact sport. You have to really get out there and make sure the firm's investing in you and make sure you're investing in yourself.
I might
go ahead.
I mean, just a frame on this AI from our perspective, where we have such concentration in terms of what we're buying, And it lines up with four sort of corners, right? First, we have to originate the transactions. We have to then make an investment decision. Third, we have to operate them. And lastly, we have to exit them, all within a window of performance. And we're going to begin experimenting next month in our investment committee with an AI agent that will join the investment committee. And so you would have a team that might bring a large transaction to the investment committee. Let's say it's 8 different people. And they would have invested countless hours, researching the arithmetic on that transaction, assessing the competition, talking about the exit opportunity. They would have, in that analysis, done lots of work around comparable transactions, public market, private market, setting benchmarks for how we might set up a valuation. And think about if we're in that meeting and somebody in the investment committee says, well, I see that analysis you did there, and could you do it differently for me? And the AI agent entered that in, and in 5 seconds, it spits out an answer for you. That's really interesting, and there is no question it's going to change how we think the composition of the teams that go into what we've done for the last 25 years. That's going to be a fundamental change.
Okay. So let's talk about your actual work and the importance of public-private partnerships. So given the increased amount of governmental debt globally, and the geopolitical tensions that are unfolding around the world, when you're thinking of infrastructure projects, how do you think of those partnerships differently today than you might have a few years ago?
So I think there's two answers to that. The first is the level of government debt and the ability of governments to fund the scale of the projects involved. If you think about the key drivers of infrastructure, digitization globally, which includes, not only digitization of the economy generally, but also kind of AI, cloud, power convergence. It includes the refurbishment of existing infrastructure, and one only need to travel to many airports in the United States to see the degree to which we need refurbishment. And that would include things like the electricity grid here, which was effectively designed for an electricity system that was 70 years old. So refurbishment, developing markets, 60% of the capital required in infrastructure over the next 25 years is in the developing markets. And then the energy transition and decarbonization. So that scale comprised with the lesser abilities of governments to fund all these projects is going to lead to a proliferation of public-private partnerships. And we're seeing it today across our entire business. I think what you have to be able to do, though, is show the government or the partner the value proposition. You have to show that you're more than just capital. We just did one in Malaysia where the government saw that the quality of the airport and the way the airport operated was truly affecting their economic proposition. They were not getting the level of tourism or business interest in the country because of the condition of the airport. And so they needed an operating partner who could deliver on that. And we had the capability to do that. We structured it, though, where the 2 sovereign funds in the country would control a majority of the equity. It's a flagship asset that a country, in most cases, Australia would be a bit different, where the government doesn't feel a need to control the airports. And that was a way we could do what the government wanted, but really retain the operating, control of the asset in somebody who knows how to do it. And we're going to have to deliver. They have high expectations in terms of what we deliver in terms of performance.
Okay. So when I started my career, there was a pretty clear diversification strategies in which assets were correlated and which ones weren't. So Raf, I want to go back to you. As we've seen an increasing correlation between equities and bonds, do those traditional models still make sense when these asset classes are tending to move unidirectionally?
Yeah, I think the models that you refer to are all based on observing the world since World War II. How are markets behaving since World War II? And we've actually been in a pretty consistent geostrategic economic regime since then. So We're actually moving out of that regime now into a different one. And if you look back in history, the world's been in these cycles before, so it's nothing special. It's just that we're not old enough to remember. And so we don't expect those correlations to hold, at least not through all time periods. And so it's really important, I think, that our industry, and that when you're talking to the financial planners that in turn talk to their clients, they understand that some sort of equity bond portfolio isn't just going to be the optimum thing through all market cycles. And we've actually referred to the Geopolitics paper, but we also wrote a paper called The Death of Traditional Portfolio Construction, which talked about this point. So it's not that in every market cycle bonds won't be defensive. They'll be defensive in a traditional recession type environment. But in many, many cycles, stagflation being one, they just won't be. And so we just have to be much better at our game as an industry than just relying on the classic modern portfolio theory, capital asset pricing model sort of approach.
Okay. So I know even as deep as the bench is here in all of your companies, you still seek other partnerships to give clients more opportunities. So Mike, tell us a little bit about your partnership recently with KKR, how it came about, what you think the benefits are for both your firm and your clients.
So the partnership with KKR, we announced it a year ago. Our first two strategies where there's 60% public, 40% private, 60% public us, 40% private KKR, obviously. They just came in the market last week. And the reason we wanted to seek a partner was neither of us could achieve this by ourselves. We are not a private manager in terms of assets. They're not a public manager in terms of assets. They're really good at what they do. We believe we do a reasonable job on our side. And if you combine those together and you make accessibility the key point, $1,000 minimum, less than 1% fee, not taking any carry, training and education of financial advisors, you give people access who haven't typically had access. Institutional space have been into the private asset market for 30 and 40 years. Wealth management, vast majority of wealth management financial advisors have very, very little private assets. And so by putting the two together, it's a lot easier for us to say, come on the journey, do it in a calm way, in a more liquid than standalone alternative way, in a cheaper way with greater accessibility. It opens up that market to a whole cohort of end investors who may want to take the journey but want to start off slowly. And the way in which we think about it, and KKR has been a fantastic partner, is they can get the best of both worlds in a single vehicle that's not just a bolt together. It's not just the 60-40 bolt together. It's the investment teams meeting together, lots of lawyers in the room, but meeting together and making sure they're sharing ideas about portfolio construction and cash and asset allocation and sector skews and all of those things to deliver a singular outcome. It's a really interesting way, we think, to have folks get access.
Mm-hmm. Okay. So Bill, let's go back to Nuveen for a moment. Just given the length of time that the company culture has been in place, with you as the CEO, like, how do you think about passing that value system that was so much a part of the brand down, and what's your stead to your employees as the leader?
Well, I mean, Nuveen being around 125 years, it's easy to maintain the culture over that 125 years. And what I mean by that is everyone knows the history of John Nuveen. They know they've been innovative. We know we've created an organization that has a public to private platform that is pretty differentiated in the market. We're an asset owner, so we're investing alongside of our clients as well. And we just build that every day with our client base and with our own staff. And when you can drive that home, talking every day with your clients, you drive that home every day talking to your own staff, people see the success that you have. And when you have that, the culture builds on itself and the people start building and building and building. But so I think it's just, you just got to stay at it every day with being in front of your clients, being in front of the staff, bringing who you are and bringing that innovation to your end client. When you deliver, you can kind of maintain that culture within the firm. At least that's the way I think about it. But I think, going back to something that Mike said about the public to private, bringing these asset classes to our end clients, both institutional and to our retail client base, that's the future of the world. It's just, we used to call it traditional and alts. It's just public and private now. I mean, that's how you talk about it. It's just different ways to access different types of returns, different types of risks, different types of investments to diversify your portfolio. And we're talking about that every day with our clients.
I might just add that, there's a much greater part of the economy that's in private lending and private assets than there were 10, 15, 20 years ago. And so there's almost a fairness about it. 20 years ago, people invested and they got to invest in the economy. And now there's a whole group of people that are not investing in some of the most exciting parts of the economy. And so there's a fairness to it. And there's the reality that alternatives are illiquid. And so that's where when you think about it, that's where the innovation is coming. That's where the vehicle innovation is coming. The asset allocation, liquidity management is much more important in the future. And I would agree that we're beginning to see clients begin to think about, well, what's my credit exposure, and not talk about private credit or public credit. What's my growth exposure? And I think we're going to look back in 10 years and there's going to be a shift in how people think about their exposures. Partly because they are similar, it's just the liquidity is different. What people are ultimately investing in is similar than it was 20 years ago. But now, for example, companies are staying private for longer because of lots of rules, regulations. It all started changing when the SEC made a bunch of rule changes in the early 2000s. And why shouldn't the world population have access to that?
Participate. And when you think about the concentration, right? So 20 years ago, also, the U.S. Was about 30% of the global stock market. Today, it's probably 55% or so. And to Raf's point, does the U.S. stay as attractive? There is some sentiment about anti-U.S. assets right now. How do you think about that going forward?
You're asking?
Yes.
Yep. So I think what's clear is that the U.S. represents 70% of, we'll talk about the stock market. I mean, that's only sustainable if the earnings come through. The earnings have also, U.S. earnings have grown faster than earnings in Europe and other parts of the world. And the multiples have gone up because of the growth profile as well. So I really think it's a combination of what happens with everything happening, what happens to the growth outlook. I hope we talk more about AI coming up. But one of the things that's clear, if you take that extreme U.S. dominance, it's because of the dominance of the technology sector particularly in the last 5 years, but also over the last decade. And the question is, will they still dominate? I suspect the U.S. will still dominate technology innovation in the next 5 to 10 years. But the concentration of the markets has to disperse and get broader, or you can't justify the valuations of those stocks. And so it'll be interesting to see if your AI agent helps you. I suspect it will. I know we're beginning to see some really positive use cases. And so you'll get this natural benefit of the technology that was generated in the US. And the question is, who adopts it fastest? Will it be US companies? Will it be European companies? Will there be leapfrogs in emerging markets using this technology? How will China develop in the race to develop applications? And how will all of our companies either get more productive or more innovative? And where will ultimately, 10 years from now, those earnings be? I think it's too early to predict, but with 70% of the market cap in the U.S., I would take the bet that it will be lower going forward.
And how about
the risk to that? Right,
yeah.
Is, firstly, I would say that's true because of the phenomenal success of those companies, and they're global. and much of their revenue comes from the rest of the world.
Yeah.
And so in this environment where the US government is picking a fight with the rest of the world, there are risks concentrated in those companies from regulation and other rules from the rest of the world that now investors are taking a huge exposure to just because of the concentration.
And how do we think about the $36 trillion of debt the U.S. has, and we just crossed $1 trillion of interest expense? I mean, we probably have a view here in the U.S., but Ralph, what's the outside of the U.S. view of that?
Well, I think the point of that is you can get away with that while you're in an attractive place for capital to come. You can fund your budget deficit. But for a country that doesn't really save very much, you know, to be running a massive budget deficit and then starting to allow people to ask questions about how successful will my global companies be because what other governments might do, or how stable will my currency be because of our own policies around it, or the independence of the central bank or any other sort of thing, that's when you risk the house of cards.
Okay, Mike, you want to say?
Can I ask him a question? Like, what do you think other governments could do? Just curious, like.
Well, I mean, I think
brainstorm.
the Europeans have already said what they want to do to all the big tech companies. It's just that they agreed not to do it in terms of regulation, taxation, access to data.
Yeah, and the only thing I was going to say is you had effectively 15 years where one thing sort of worked. It's if you own the S&P 500, you own the US dollar, you did pretty darn well. And every time you diversified, you felt like it hurt you. And you did it because it was cheap, because there were good opportunity, because they're well-run companies, that it's a great company and less of a good neighborhood, all of these things. What you're seeing now is, I think, a big and. It's not S&P 500 and then everything else. It's this big and where you can evaluate opportunities in this broadening based on the opportunities that you see in individual companies. Like Raph said, a lot of these companies are global companies. Where's their production? Where are their customers? What's their currency exposure? It can become much more complex and interesting and beneficial to be and instead of just the S&P 500. And I think I think it's the beginning of that and that will, and Gene talked a little bit about it. I don't know if it'll be 70%, 65%, but I think you're seeing investment professionals look around the world at opportunities. And that's a really good thing, just in general.
Mm-hmm. So one trend that I think is interesting, is unfolding right now, is that we're in the beginning of the largest wealth transfer in the history of the world. Some $70 trillion, $80 trillion is going to pass from one generation to the next. So running a firm that wants to retain those assets, how do you, I'll start with Eugene, how do you think this inheriting generation might differ from their parents in activating the capital and how they invest it?
Well, I think it goes back to how do you motivate our younger generation of employees? I think it's about purpose. It's about how, what are those assets doing to help the world? I think this generation
resonates more with younger people.
Really cares about the world. It cares about climate. It cares about they're very technology savvy. And so I think it's about what will motivate this generation to invest in the end, it's their capital, right? In the end, in this wealth transfer, it's their capital, and so what kind of investments will they be interested in? And I suspect there'll be more. I mean, the next generation very much cares a lot about the world
and sustainability,
and social justice. And so, how does that play into the investing world, and what companies will benefit from that? And I think we sort of know that there's going to be these new vehicles and a greater way of democratizing alts and bringing the whole economy to the wealth market. And I think it's probably early days, but how will we deliver that in a more digital way over the next decade? I think it's still too early to know, but that probably will really, will we catalyze invest in this generation? Will they really care about how they interact with their financial advisor, how they interact with their asset manager? I think that will be another thing that will be quite interesting to see.
Okay.
Rich, what's interesting with what we're all talking about in terms of the broad themes, obviously, privates, the wealth market, technology. One big theme that I think is out there in our market today is retirement and the aging population and how people are going to retire in the future. And we're all putting in our target date funds private asset classes. But now we're starting to innovate, putting annuities into target date funds and bringing that to the DCIO market. And I think that's a big trend and will be a big trend as we move into the coming 2, 3, 4 years.
In 1900, the median age globally was 32, and today it's 73. So if you knew that the whole world was going to live 40 plus years longer, right, you might have established a different retirement structure. So when our retirement structure in the US and many others was established in the 1930s, it's much closer to 1900 than it is to 2025. So we need to rethink that. And a lot of this aging infrastructure, back to you, Matt, when you started this company nearly 20 years ago, what was the opportunity set then that made it attractive, and what's changed over that time, and how can tech help you in the future?
So I think the world has become even more global, and the complexity of delivering everyday services that infrastructure delivers has become more expensive, bigger scale, bigger funds required to do it. That being said, I think the opportunity today from the investment set is as good as it's ever been, and frankly, is better than it's ever been. We're, in my opinion, sort of on the front end of a golden age of infrastructure because of the things I mentioned earlier. So, and I think right now, given a lot of the dislocation, we're seeing buying opportunities that we haven't seen in a number of years as a result. I think technology is really important. I mean, I coined a concept here last year that I refer to as infratech, which is the convergence of technology and infrastructure. And yes, it's AI and it's machine learning. How do you run a grid more efficiently? It's robotics, it's sensors, it's markets, it's distributed ledger. All of that is going to contribute to what I think is essential in terms of this next generation of infrastructure, because in my opinion, we have to decarbonize, and people may have a disagreement with that. I think the evidence is clear. It's not easy to do for the reasons I mentioned, but the infrastructure that we design has to be more efficient, more resilient, and lower carbon intensity, and technology is going to play a big role in that.
Okay. And are there any risks that investors aren't seeing on the horizon that you all are worried about? Start with you, Mike.
I'm sure. Look, I mean, if you looked at everyone's expectations coming into this year of deregulation and lower taxes and what the expectations were that the president wanted in terms of an outcome for the equity market, you would have thought that things would be flying. I think the problem that we're seeing right now is every panel like this in the world is saying the same thing about there's lots of uncertainty because we're all trapped in the moment, and there is tremendous amount of uncertainty in the moment. It's not enough looking out 5 or 10 years. We had a conference in London about a month ago, and it was one of the days where the S&P or NASDAQ was down 7% one day and up 9% the other, that 2-day window. And our whole focus during that conference was the future. And it was great because, we told people, just sitting in the audience for 2 days, we saved you money in transaction costs. You didn't have to do anything. So I think there's going to be a lot of opportunities, and the risks we see are right in front of us. But if you can look out 5 or 10 years and find great companies with great management that have a moat around their business, that are evolving in what they do, there's always going to be opportunity. There's always going to be innovation. So I sometimes love the noise of the moment, just because it reminds you to try to get yourself away from it and think about 5 or 10 years out, and it's liberating in many ways.
Okay. And Bill, you were talking about retirement. There's a growing risk in the United States. 40% of the people can't meet an unexpected $400 expense, right? We seem to be in our own echo chamber, but that's the reality. What on the retirement horizon, like what is the risk of all these people like entering retirement with not enough assets, and how do you think about that?
Yeah, I mean, I think that's what I was kind of alluding to earlier. We've created what's called Nuveen lifetime income. They're target date funds that we embed a annuity in it from TIAA. We've been doing this 403B market for a long time at TIAA, bringing it to the DCIO market. And that if you can get that early into someone's allocation, in their 401k, and they start building over years of time, then they're gonna get this stable income stream as part of their asset allocation during that period of time. And when they go to retire, they're gonna essentially, have lifetime income that they can convert that annuity into. And so it's almost like embedding a DB and a DC plan together in some way, shape, or form, if you will. I think, doing that early, educating young people early in their careers when they're investing their money, and having a solution like that can make a real difference in when they retire.
Okay. And Gene, any thoughts on that? On the retirement question? On
the retirement question, well, maybe I'll offer a perspective that people are going to need more retirement if everything that we see happening in biology happens.
And people are living longer. Right?
So I actually think it's really quite an interesting question. You went back to 100 years ago, the infrastructure, Medicare, when Medicare was enacted, people lived till 67. That was the average age, life expectancy. Yeah. So I think the government thought they would be paying 2 years of Medicare. So I think the biggest question is, how do we fund retirement if people live to be 90 or 100, or a much greater portion of people live to be 90 and 100? And I would make the bet that that's going to happen. And I know that's not showing up in the statistics right now in a country like the United States. But if you fast forward 10 years and you've had a whole generation, like my generation, of people that will be on statins, blood pressure medicines, GLP-1s, you're just going to lower the morbidity and mortality of people dramatically in the next 20 years. So I think, how do we lengthen, extend retirement? That there will have to be a significant mind share shift about work probably, and how you invest your assets.
As a seasoned healthcare investor, are there opportunities that you're more excited about in that?
I think that what I'm most excited about is, I do think GLP-1s will be very broadly used, and sort of every outcome study so far has shown benefit. And you've seen it in cardiovascular, you've seen it in kidney, you've seen it in sleep apnea, and we will over the years see it in Alzheimer's. We'll see it in lower cancer rates. When you think about all the medicine that's happened in the past 30 years, the benefit of it has been offset by the gain in weight that the world has seen. And so I do think that you will see a real bending of the mortality, morbidity, cost curve of healthcare. And so that's pretty exciting. And so how do you get those drugs? The fact that we now potentially have an oral drug, there was one study that one of the drug companies did that looked like it works and it's safe, that's exciting, because that will bring it to more and more people.
Okay.
So that would be one. I think the most important thing, though, is the fact that in 2025, there's ways to treat every kind of biology. When I first started, there were really only oral drugs that treated tiny targets in the body. And then, at the end of the 90s, you had antibodies that allowed you to go after large receptors in the body. And now we know we can go after RNA, DNA, all sorts of and biology is wide. And so what causes disease? Is it caused by this RNA target, or is it caused by this enzyme? Is it caused by a small receptor or a large receptor? I think until about 10 years ago, you really only had a very narrow way to treat biology. And to me, so it's like the breadth of ways to treat is what's the most exciting for the world.
Okay. And Ralph, let's go to you again. As a non-U.S. investor, as you were talking about the U.S., where are you deploying capital outside the U.S. that you're seeing opportunity?
Yeah, so firstly, just to put that in context, you know, the US is a remarkable economy. It's hugely innovative. It's a country that's attracted clever people who want to make something with their life and are willing to take risk, and we see the manifestations of that in the economy, the market, and we've had mostly very open markets, clear regulation, independent institutions, and that's why the markets are expensive relative to the rest of the world. It attracts more capital. Companies come here because they can raise capital more cheaply to grow and invest and grow nationally. So it is a challenge as a global investor to say, well, all those things are still true, there's a bit more risk now. And so if I want to put a bit less there, because remember it's 70% of the market, so every new dollar I've got probably 70% is coming here unless I change something. You know, let's put the cost of capital up for the US a bit. Well, where else would you go? Now, I think for us, there's sort of three places that we're quite interested in. So Europe, yes, you know, they've got demographic problems, yes, the economy's pretty flat, all those things are still true. It's a lot cheaper, but also, you know, something's unlocked there, actually. Before I said geopolitics is driving markets, the events around the sort of Ukraine relationship and NATO have prompted European countries to snap out of a stasis they've been in and say, we're going to invest in our countries, we're going to borrow money, we're going to have a fiscal spend. That's going to not just be an economic tailwind, but lift the yield curve, probably generate some inflation, and as long as you sort of ride through that, you don't have too many assets there to start with, that means returns will be better. So we're quite interested in that, especially in things like private credit and some private equity strategies that are niches. Japan's really interesting. Yeah, it's done pretty well over the last few years, and yes, the demographics everyone understands, but there's a real change in attitude to risk-taking, a willingness to energise and invest in their own economy, in their own companies, and really, I think as the generation that went through the bubble in 1990 sort of leaves the workforce and decision-making positions, the younger people, if you haven't been there recently, are willing to take risk and invest in companies, and there's an emerging, for example, venture capital industry in Japan, interestingly. And so, and there's a bit of inflation there, the same type of effect, so that's quite interesting. And then for us, we're an Australian investor. Our liabilities, not that we have them actually, but our stakeholders' liabilities, the government, are in Aussie dollars. It's still a growing country from a population point of view. There's certainly things we should be doing to become more productive, but we know what they are. And so we're taking some money back home from our perspective back to Australia. And funnily enough, really because a lot of the super funds, which are the bulk of the institutional investment capital in Australia, are so full on Australia because they started investing there and they're only starting to go offshore as they get much, much bigger. Actually, the returns we can get back home are going up at the moment. There's less competition for things than there has been.
So I want to end on an optimistic note. So I want each of you to tell me what the trend you are most positively inclined to for the next year, and what makes you optimistic. Start with you, and we'll go down. Yeah.
The trend. This is on the being a CEO of the asset management industry. I think the most for me, and I'm gonna talk about our own company. I think it's the broadening out of the market. And what I mean by that is you have a whole series of investors the last 5 years where the concentration of the benchmark has been so frustrating. And so I do think this broadening of the market is going to, I think it's really exciting.
Okay.
Yeah, I would say for me it's the public to private investment landscape and bringing credit, like we were talking about earlier, just bringing credit and equity to our clients across that platform and globalizing the business.
Okay, well.
democratization of alternatives, specifically infrastructure, but having been largely institutional, having the ability to make infrastructure available to a much wider investor audience.
Mike?
Two things at the same time, the broadening of the markets and also with our partners, a narrowing of the number of partners they use to do more for them. Those are both powerful forces.
Yeah, I think something similar, but it's the, part of the same trend is that actually a lot of different parts of the world are becoming interesting places to invest in. So you call that the broadening of the market maybe, but it's more than that. It's the economic growth, the jobs, the prosperity, and I think that just makes it's great for active investors, all of you up here are. But together with that, we haven't really talked about it much, but AI, I think, has the potential to drive a massive productivity boom in our companies. And, we heard Elon Musk yesterday talk about the potential for using the government to make it more efficient. Let's hope they can. It really, I think, will be game-changing.
Well, great. Well, I want to thank you all for your participation and enjoy the rest of the conference. Thank you.
Thank you.
Just keep your eyes on me. I said you're holding